The company Block, ticker XYZ, was up 25% on the news that the business was going to fire 40% of the company's staff. Jack Dorsey, the CEO and entrepreneur behind the creation of Twitter, used AI as the reason behind the move. No doubt Block, seeing the significant rise in its stock price from this move, is going to motivate other companies to follow suit. These bloated technology organizations are going to fire tens of thousands of people and flood an already crowded labor market with even more layoffs. Dorsey made a decently long post on Twitter explaining why they decided to go through with these layoffs, and I'll read off a good portion of it. He said, "Today, we're making one of the hardest decisions in our history of the company. We're reducing our organization by nearly half, from over 10,000 people to just under 6,000. He continued, "We're not making this decision because we're in trouble. Our business is strong, gross profit continues to grow, and we continue to serve more and more customers, and profitability is improving. But something has changed. We're already seeing that the intelligence tools we're creating and using, paired with smaller and flatter teams, are enabling a new way of working which fundamentally changes what it means to build and run a company, and that's accelerating rapidly." So his reasoning, at least the cover, is that the company thinks it can use AI to replace all of these people. And Block is far from the only business doing this. According to consulting firms like Challenger, Gray & Christmas, which is a global outplacement firm, there were 55,000 job cuts related to AI in 2025 alone. Programs.com estimated that there have been 22,000 AI-driven layoffs in just 2026. So Block is not the first company to do this, it's just the most aggressive and most transparent about why. Now let's run through the list. First, we have Klarna, the buy now, pay later company, which has been a topic of much controversy. They cut their workforce from over 5,500 to just under 3,000 over the past 3 years. The CEO of the company was the original poster child for AI replacement, and he bragged that their AI chatbot was handling 2.3 million conversations and doing the work of 700 customer service agents. And revenue doubled over this time period. And then by early 2025, they realized they went overboard and started rehiring. Amazon's another big one. They've cut over 30,000 corporate jobs across late 2025 and early 2026. And they've been using AI as an excuse, but many of those roles have actually been outsourced to India, although there have been some layoffs in India as well. Salesforce slashed 4,000 customer support roles with their CEO saying that AI now handles half the company's work. And Microsoft cut around 15,000 jobs. Accenture announced 11,000 layoffs tied to AI restructuring. And even Citigroup is planning to reduce headcount by 20,000 using automation and AI-enabled systems by the end of 2026. So this is happening at a variety of the largest employers in the United States, especially the technology companies that have historically had bloated employee counts long before this point. The reality is, while all these companies are listing AI as an excuse, many of them were just looking for any reason that they could get rid of the workforce that they'd overhired throughout the last decade. That, or the jobs are being outsourced overseas to markets with cheaper labor like India. In terms of which areas are genuinely seeing AI automate much of the tasks, we see that in customer support, back office operations like HR, and repetitive sales development roles. Now, customer support is the most advanced use case. As we mentioned before, Klarna's AI chatbot has been taking over the work of over 700 agents and led to an 82% faster response time while doing that. Salesforce reduced its customer support division from 9,000 to 5,000, and Gartner forecasts that AI will autonomously resolve 80% of customer service issues by 2029. Now, back office operations are another common target because they offer reliable savings for tasks that are commonly known for being repetitive and well-defined and are not typically customer-facing. Now, IBM's Ask HR agent automated 94% of their routine HR tasks and contributed to a 40% reduction in their HR operating budget over 4 years. So we're looking at this, and as investors, we should be thinking about how we could identify other companies like Block that have room to significantly reduce their workforces and increase their margins by bringing down those labor costs. And that's exactly what a firm like Elliott Management has been doing, the $80 billion asset manager. Elliott has taken major positions in Salesforce, PayPal, and Pinterest, acting as an activist investor, pushing these companies to reduce their headcount and cut costs. A lot of these companies can be identified by looking at the revenue generated per employee or the SG&A expenses compared to their revenues, the selling, general, and administrative expenses that correlate to general costs like salaries or marketing. Given how we saw Block's share price rise by 25%, if we can position before these companies make the decision to enable mass layoffs, then that could lead to a nice return. Not that we like to see layoffs, but it's just the way the world is going nowadays. So, I'll provide a list of companies to research that could be likely candidates to start implementing AI, or at least use it as an excuse to reduce their headcounts. And I'm not endorsing any of the companies that I'm going to list, but I'm just providing names for you to research further if you like. Now, as I already mentioned, Elliott Management took positions in Salesforce, PayPal, and Pinterest, so I'm not going to go over those again. But in terms of other options, you're looking at platforms like Workday, which offer HR services, and they had their first ever large layoffs in January 2025 when they cut around 9% of their jobs. And AI could be used to reduce Workday's roles in sales, services, and support functions even further. DocuSign, which is the technology for secure signing, is a company that's commonly mentioned in the overhiring conversation. They had 7,000 employees at its peak, and AI could be used to significantly reduce its workforce without seeing a large difference in business performance, I'd have to imagine. Okta, the employee secure identity platform, over doubled its headcount in 2022 from 2,800 to over 6,000 roles, grossly overhiring. The company's only done modest cuts so far and could definitely implement AI to cut further. The last obvious candidate I can think of was Zoom, which tripled its headcount during the 2020 era from 2,500 to 8,400 jobs. Revenue growth has largely stalled for this company, but there is room to drastically reduce the workforce at a company like Zoom, which investors would appreciate. And the important thing to take note of here is that Block was not the first company to see great results from reducing their headcount, and they're just in the news because they saw a big boost in the stock immediately. Shopify actually cut 30% of its workforce from 11,000 to 8,000, and their free cash flow swung from a negative 186 million to a positive 2 billion. The CEO is asking employees to now confirm if AI couldn't do their job itself before approving any new hires. And some other companies have seen solid results, but you get the point. The trend is only going to continue in this direction. Whether that's for better or worse largely depends on the company that you're looking at. Now, the best results in terms of returns in the stock markets are obviously going to be before the news of layoffs comes out. So it's going to be important to track any disclosures by activist firms like Elliott that might force changes, or comments from management on how they might want to use AI in the future. As I've said, I'm not rooting for layoffs. I think it's unfortunate, and it's a sign of an economy that's going down the tubes. But as investors, we're here to make money, not debate the morality of these situations. So that's what we're looking at, and thanks for watching.